Hey everyone, welcome back to Corporate Decoded, the place where we decode the language of big business and what it reveals about the real story. And let me tell you, Ralliant Corporation's latest filing has a story to tell. It is a story of a company finding its feet after a major split from its parent. And the numbers paint a surprisingly complex picture before we dive in if you appreciate getting straight up. No! Nonsense insights from corporate filings like this. Hit that subscribe button and ring the bell so you never miss an episode. And if you want to chat about these filings and get even deeper insights, join our Discord community linked in the description. So RAL is this company that recently went public after separating from Fortive Corporation, its former parent company. Imagine splitting off a whole piece of your business and then having to stand on your own 2 feet. Well, that is exactly what Ralliant has been doing, and this filing is like their first full report card as an independent entity. Now, right off the bat, the financials for 2025 look pretty rough, a big operating loss of over $1 billion, but hold on before you panic. Remember, this company just became its own thing last year, so there are some really big ones. Time costs happening here. The biggest culprit was a massive goodwill impairment charge of $1.4 billion in their test and measurement segment. This basically means they had to admit that a previous acquisition or part of their business simply wasn't worth what they thought it was worth anymore. It's like buying a house for $1 million and then realizing it's only worth half that after that big write. Off their total revenue actually dropped about 4% last year. That's not ideal, but it's important to see why. Let's break down that revenue drop first. The company highlights that organic revenue, which just means sales from their existing businesses, without counting any new acquisitions or currency swings, went down about 4%. This was mainly due to lower sales volumes, a significant 7% drop, which the company blames on weak demand across different markets. They did manage to increase prices. Slightly by about 3% though, so that helped cushion the blow. A bit geographically, sales took a hit in Western Europe and China, but saw a small increase in the rest of the world. Looking at their two main parts, test and measurement, saw a really tough year with sales down nearly 15%. Their operating profit here also took a huge hit, going from a profit to a massive loss. Again, that goodwill write-down is a huge factor here. The revenue drop was mostly from lower sales volumes, meaning they sold less stuff. Even though they raised prices slightly, the company blames this on weaker demand, particularly in the diversified electronics and high-power solutions. Areas think less demand for the tools engineers need to build advanced electronics. But it is not all bad news. Their sensors and safety systems segment actually grew sales by over 4%. This segment is doing better thanks to price increases and a bit more volume driven by demand in the utilities sector. They also saw growth in China and other parts of the world. This part of the business seems to be holding up much better than test and measurement. Now let's talk about that big number that skewed the 2025 results, the $1.4 billion goodwill impairment. Charge, the company says this was due to revised expectations for their EA Electro automatic business, which supplies high power test solutions. They now expect slower growth in electric vehicle adoption than they originally thought. When they bought this company, this is a classic example of overpaying for an acquisition based on overly optimistic forecasts. It's a big red flag in terms of their past acquisition strategy. Beyond the financials, there are a lot of risks, Ralliant points out. Trade policies are a big one. Tariffs and trade disputes, specifically with China, could continue to hurt their business and increase costs. They also face intense competition, which could force them to lower prices. Their reliance on new product innovation is key, but if they don't innovate, it's a problem. Cybersecurity is also a major concern. And as it is for most tech companies, they specifically mentioned threats evolving, particularly around cybersecurity, and that their insurance might not cover all potential claims. A big theme here is that Ralliant is still figuring things out as a standalone company. Their historical financial data prior to the split from Fortive isn't really a good guide because they had Fortive support for many functions like legal and finance. Now they have to build all that themselves, and that costs money and takes management attention. The separation cost is a significant drag on their current performance. Let's talk debt. As of the end of 2025, they had over $1 billion in outstanding debt, and guess what that debt is costing them? A good chunk of money in interest payments, over $32 million in 2025. Alone, this debt makes it harder to pay dividends or buy back stock, and they need to be really careful not to breach the rules or covenants in their loan agreements. And the bottom line for 2025 was a net loss of over $1.2 billion. This means for every share of stock they have, they lost more than $10 basic and diluted loss. Per share are both around $10.84. This is definitely a company in a challenging transition phase. Now, for my take on Ralliant based on this filing, it is clear that 2025 was a year of massive transition and significant one. Time costs the huge losses mostly due to that goodwill impairment, which is a serious signal about past acquisition decisions. The test and measurement segment is struggling considerably, while sensors and safety systems is showing resilience. But the company is actively trying to manage these challenges with price increases and cost-saving programs. The debt load is significant and will require careful management, but their credit facilities provide some breathing room. What's really important is their ability to innovate and integrate new products quickly and to successfully navigate the competitive landscape, especially with the ongoing separation costs, and management acknowledges their limited history as a public company, so they are aware that the road ahead will be about proving their standalone viability. So what is the takeaway? Ralliant is a company in a major reset period. The financials for 2025 are heavily distorted by one-off events. The key will be whether their sensors and safety systems segment can continue to grow and offset weakness in test and measurement, and if they can manage their debt and separation costs effectively without further major write-offs. It's a high-risk, high-reward situation for investors right now. What do you think about Ralliant's future after this split? Are you watching this company? Let me know your thoughts in the comments below. If you found this deep dive valuable, give this video a thumbs up and subscribe for more. And don't forget, join our Discord community, link down below for more discussions. Thanks for watching, and we'll see you in the next Decode.